Hello, everybody. Greetings. I'm here with Amy Dietz.
Hello.
How you doing?
Good, Neil.
Good. Happy New Year.
Happy New Year, 2023.
Glad to be back in the office and everyone's hustling and bustling about, which is kind of good
It's
to
the
see.
time of the year where we get the question, what's the year going to look like?
I'd like to see more than 50% of the people in the office.
Yeah.
I'd like to see that. I'm not going to lie to you. Anyway, whatever. What do I know?
Yeah.
The Kraken. Anyway, to be discussed. Anyway, today we're going to look at the 2023 outlook in terms of what we see happening in the economy, what we see happening in the markets. We're going to cover off, fixed income, equity, maybe touch on a little bit of real estate. All sorts of things are going to be discussed.
Yep.
We looked at about, I'd say somewhere between 15 and 18 economic outlooks for 2023.
There's always an outlook, isn't there?
There is. But from institutions ranging from JP Morgan to Morgan Stanley to, some European ones like Credit Suisse and so forth, even our own national bank, Royal Bank and so forth.
Yeah.
So I think, we have some pretty interesting observations we'd like to share with you, and hopefully you'll join us coming up next. But before we go, we have to do disclaimers.
It's my disclaimer hat. I actually have a hat now, guys. All right. This is official because we're talking about securities and outlooks. So securities and sectors and outlooks mentioned in this letter are not suitable for all types of investors and should not be considered as recommendations. Please consult your wealth advisor, that would be us, to verify whether your security or sector is suitable for you and obtain complete information, including main risk factors and other pertinent information around the security. Some of the securities or sectors mentioned may not be followed by analysts at National Bank Financial. So coming up next, let's talk about outlooks for 2023.
Welcome back, everybody. So why don't we cover off the first aspect of our 2023 outlook? And let's remind everybody, we've looked at no less than about 18 sources of outlooks of financial institutions across not only North America, but Europe and even Asia. So, so let's talk about the overall economic situation. And you can imagine when you're assessing a whole bunch of different opinions, and each opinion's trying to put themselves out in the forefront in terms of their thought leadership. So you have to govern your assessment of that accordingly. I mean, I'll give you an example. I have the investment outlook for Morgan Stanley right here. We see a resilient economy without a looming collapse. Right underneath it is JP Morgan, a bad year for the economy, a better year for markets. So
a bad year for the economy, a better year
for markets.
Bad year for the economy, a better year for markets. Okay, sorry. And those are two very well-respected, investment houses and
100%.
two somewhat different, let's say, outlooks in terms of the economy. And also, an outlook is only as good as the paper that it's written on. Oftentimes, when we wake up in December, things will look markedly different than what was predicted.
Well, and it changes throughout the year too, right? They're always, changing their targets and things like that.
So here's what we're reading. Okay. One, when you raise interest rates as quickly as they have gone up in North America, you are going to see a slowing of the economy. I've been saying this for a while in our podcast that this has been a purposeful slowing of the economy by the Fed in the States, in the Bank of Canada, and the ECB and the Bank of England. So that I think the intended effect is going to happen. The first interest rate increase, I think, occurred in February 2022. So it's around a year since the first increase. And we're going to start seeing the real impact of these rate increases starting to take hold in the coming months. So I think you'd be somewhat Pollyannish to think that there isn't going to be an economic slowdown in the coming months. North America. And
I think a lot of the companies at the end of last year, they were guiding lower, right? To be conservative and the anticipation that things are just going to slow a bit.
Which they should.
Yep, okay. Exactly.
So that's that. I think, but in let's say in concert with that, you are going to see inflationary pressures drop. Okay, it's not going to be like a precipitous drop like you're jumping off a cliff, but you're going to see starting around now. I think you're going to see a month by month tick down in inflation, which I think is what central banks want to see. And so the pace of increases, I think this year, are either going to stop at some point in the next 3 to 5 months, or the pace is going to slow. Pace of increases is going to slow down. My bold prediction, this is just my bold prediction, take it for what it's worth, is by this time next year, you're going to be talking about rates coming down with central banks.
Yeah, I could see that.
Okay, that's my guess. You're going to be looking at them to actually taking rates down. So this is also probably going to be based on what I've seen and read, and you guys feel free to jump in, but this might be the most peculiar recession or economic slowdown I've ever seen, because you're not going to see the layoffs to the same extent you would have seen layoffs, for instance, in the early 90s when there was a recessionary environment, or the Great Recession of 2008. I don't think you're going to see that here. What you're going to see is, I think, job openings are going to decline. So companies are going to wake up and say, well, wait a second, we don't need to necessarily hire.
Yeah.
I think that's going to close out. And I think you're going to see participation in the labor force maybe dwindle a little bit, as the economic changes take hold. But everything that I'm reading, if I look at 65 to 70% of the economic outlooks that I've read, they're all forecasting a very mild economic recession. It's not going to be something that is going to be as severe as what we saw in 2008 leading into 2009.
Yeah, I think so. I think everything we've read is all indicating that's the case.
There are a couple. That are saying that that the U.S. at least will be able to at least avoid a recession,
some are
but
saying
narrowly
avoid, but
one.
narrow. Yeah.
But I think the general understanding or the general idea is that we are going to hit a recession. But the nice thing is that I think they're all saying, even the ones that are saying that we are going to hit a recession, that it's going to be mild and it's going to be short-lived.
Right.
Yeah.
And just one thing I wanted to build off of what you said, Sean, about companies. I think companies are not going to go through the layoffs that we saw in 08, 09, because I know a lot of companies, like I remember after 08, 09, you started reading that companies who did do a huge amount of layoffs then struggled to hire afterwards.
Yep.
So I think, so what companies are starting to do is exactly like you said, they're implementing hiring freezes, and they're just maybe lowering the hours of their workers, especially obviously like the hourly wages.
Yep.
Not like the hourly workers, they're just decreasing the amount of hours that they're working. But in terms of mass layoffs, we're not going to see that. I know, obviously if you're going to talk about, I know Facebook just laid off, Meta laid off a lot of workers, Amazon, 18,000 workers globally. Salesforce is going to, but these numbers, even though Salesforce is, for example, laying off 10% of its workforce, these numbers are really negligible compared to what happened in 08, 09. Companies have found in the past 10, 15 years that it's getting harder and harder to hire.
Yes.
And funny enough, I was reading a report about a couple of weeks ago saying that in the next 30 years, 75% of workers will be freelancers.
Well, you bring up an interesting point, because that I'm glad you brought that up, Jalal, because there is a bit of a boom bust echo type of aspect to this, because a lot of people are retiring.
Yeah.
And so, if you lay off someone, there's a cost to doing that. Then you got to go back into the labor pool, which is dwindling from a demographic standpoint, and try and replace that hire. Then you got to retrain them, you gotta, so on and so forth. So I think companies, to the extent they can, are going to hold on to their headcount. It's a lot easier to unwind a job opening than it is to lay off an existing person.
100%.
Particularly, by the way, in Canada, because of the labor, let's say the legal employment law structure that exists within this country. It's actually much more robust than the United States, for instance. So it's difficult for mass layoffs to occur in that situation.
Yeah.
So I think that's actually, to the extent it is, somewhat positive news. Now, look, time will tell. I mean, we'll get into this at the end of this, a couple minutes around the risks to what we're talking about.
Yeah.
But that's the general consensus. Mild recession.
Yeah.
Not long lived. Most of us will not feel it in any deep, painful way. For those that do, I mean, obviously our heart goes out to people that have any type of economic hardship enforced on them or imposed on them.
Yeah.
But for most of us, we'll be dealing with higher prices at the grocery store, but they might start coming down and so forth.
Yeah.
So what does that mean for fixed income? Well, I mean, look, if inflation starts going down in the future, let's say the future direction of interest rates starts going lower, well, that's generally a positive backdrop for fixed income, right?
Yeah.
Particularly corporate bonds, but government bonds too. And so, for instance, if you see, let's say, you're looking at a 10-year government of Canada, if you see, let's say, even a 1.5% drop in the yield of a 10-year government of Canada bond, that implies a 15% increase in the value of that bond. In that sort of type of situation. So if inflation expectations grow lower, and just to put this in perspective, I mean, I'm looking at a global economics report from Capital Economics, and they're talking about, PC inflation slowing from around 5% right now to 3% late 2023. I mean, that's a steep drop. That's a 40% drop in
Sorry,
inflation.
what did you say the starting one was? 5.5?
5% is
5%,
PC.
yeah.
Yeah.
PC inflation
To-
dropping to 3%.
Yeah, that's two.
So obviously the inflation, and this is consistent across all the outlooks, that
Yeah.
inflationary pressures are going to ease. Like, I mean,
Yeah.
obviously China opening up and let's say relaxing their COVID restrictions and opening up their economy more is going to release, let's say, tensions amongst the supply chain and so forth. That's positive for inflation and so on.
Mm-hmm.
If inflationary expectations are going lower, that would portend that interest rates could go lower.
Mhm.
That's positive for fixed income.
Yeah. Yeah.
Personally, I don't. So I think UBS says that interest rates will probably go down by the summer. BlackRock literally said anybody who thinks it's going to go down at all this year is kind of foolish. So
That is
these
a little,
analysts are so like they all. Sorry to interrupt, Amy.
Yeah.
They all have their good reasons, right? But it's just obviously it's extremely hard to tell, and nobody's going to be able to tell. Who knows what the banks are
Our
planning?
National Bank economics research is suggesting that owning corporate bonds may be the best place to be in for the first half of this year.
Right. Yeah.
So
Yeah.
you're right, and that's the point we made. Like, you take this with a grain of salt.
Yeah.
Yeah.
What I do when
What do
I
you
read,
think? Like, do you think interest rates are going to start going down this year or not yet?
Well, here's what I do. I look at I've read about 18 of these.
Yeah, and that's what I'm. Yeah.
I know, there's so many.
I take a consensus view
Yeah.
and say, okay,
Okay.
what's the 70% fit
Yeah.
for what I'm seeing out there? And does
Yeah.
it jive with what kind of my experience has been economically? My feeling is that interest rates are going to trend lower beginning somewhere mid-year into the back half of this year.
Oh, so that you think they're going to start dropping?
Yeah, I do. I don't
Okay.
think they're going to drop right away.
Right.
And I don't think they'll drop a lot, right? I don't think we're not going back to the lovely low interest rate
no, but
environment. I don't think.
I'm not saying that central banks are going to wake up come this time next year and start reducing rates at 75 basis point
Yeah.
clips over the next.
No,
That's not
no,
happening.
no.
Yeah.
Agreed.
But you can see, the bond market rates in the
Yeah.
bond market drop
Yeah.
because of the inflationary pressures abating.
Yeah.
The economy's slowing down,
Mm-hmm.
and all these things. So that's actually a very favorable backdrop for bonds.
Mm-hmm.
So what I'm suggesting in a long-winded way is, bonds were not a great diversifier for the first time that I've ever seen in all the time I've followed, economics and finance since high school.
Mm-hmm.
Yeah.
Bonds for the first time were not a great diversifier.
Right.
I think that's going to change this year. Everything I'm reading is suggesting that bonds
Yes.
are going to actually act as a cushion if we have very volatile stock markets in the coming months.
Right.
Right.
Yeah, I would agree with that.
Personally, I don't know. I would say that I would argue that they're not going to come down, but who knows? Just because I don't think the economy is going to slow down to the point where
So you don't
Where they
think
have
interest
to.
rates are going to come down?
not this year. No, if anything, I think they're going to start in 2024.
Okay.
I think they're going to keep them, but
Well, that's what makes the
That's-
market. I mean, you could be right.
Yeah,
I mean,
yeah, yeah.
it's who knows. And if that's the case, why do you think interest rates are going to be persistently high?
because
I'm talking in the bond market, not necessarily central banks.
I'm talking about central banks. I don't obviously know as much as you, nor do
Oh,
I
you
have
do. No,
too
no,
much
you do.
experience with bonds. So I don't know about the bond market, but I'm
Masters
talking
of
about
economics over here.
central banks. I don't think they're going to drop.
Well, I'm not suggesting for a
anytime.
minute that central banks are going to actually reduce rates this year. I don't think. I hope I'm not coming across as
Yeah,
such.
yeah. But you think that just the bond market,
I think
the
the
rate
bond
on the bond
market,
market, yeah,
is going.
is
I
gonna
think
come
rates
down,
are going to grow lower in the bond market.
Gotcha.
Right.
On
Right.
the expectation that central banks are going to lower rates in 2020.
At some point,
your
yeah.
reports, talk to me guys about some sectors, like the reports that you guys have been reading. Any ideas on sectors like tech, whether it's health, any ideas there? Any thoughts there?
On the equity outlook.
Yeah. Well, let's just talk, I guess, equity outlook.
Well, I think that, when you look at the markets in general, say some very select sectors globally, I think the global markets have really forecasted, because if we back it up a step,
Yeah.
The markets are discounting mechanisms. They tend to look out anywhere from 6 to 9 to 12 months
Yep.
and assess what's going to be happening then, and then
Yep.
they price it accordingly now.
Mm-hmm.
And so the S&P 500 was down about 20% in 2022. So they're forecasting a pretty dire economic outlook for, let's say, where the U.S. and global economy is going to be, let's say, September this coming year all the way out to maybe December, March of 2024 type of thing, December 2023. So if you have any kind of green shoot in the economic picture, that's going to be positive for stocks in general. If inflation starts rolling over and the direction of inflation is lower, that's positive for stocks in general, because obviously that increases the value of the net present value of a dollar they earn in the future. So what I think is going to do well in the next 6 months to a year, based on the outlooks I'm reading.
Yeah.
Any company that can do well in a higher interest rate environment, so that would be banking, insurance, those kind of companies. I think high quality industrials can actually do very, very well in this environment because they're looking forward. If the economy troughs and then kind of comes out of it, that tends to be positive for industrial companies. I think health insurance in the short run, not health insurance, healthcare in general is, I think in the short run and the long term is actually a very good place to be. They got great dividend growth. Their cost structures are somewhat inflationary resistant. The demographic,
aging population and everything,
just is enormously behind, right? Amy? So I think they're actually.
Well, there's so much innovation going on in healthcare too. Like, look at how it evolved since COVID alone, right? There's so many more healthcare applications now that we just didn't have before, had access to. So
And then I think also, you mentioned technology. I do think in the next 3 to 5 to 6 months, technology, especially the big, what I call utility type technology is probably going to be under a little bit of pressure. But man, they're earning enormous amounts of money, and they're growing their dividends, and they're
the tech companies.
Yeah, I think they kind of remind me of where energy was, kind of like, let's say 2019, 2020, and not necessarily the depths of 2020 when oil went negative and stuff like that, but they just remind me they're just enormous money makers. Yeah, and at some point, things will even out for them, and they're going to still do very, very well because they're so
if you look at the problems we face today, and I like the way you framed it, the technology utility type companies, right? We're not talking about kind of the trendy fad technology. We're talking about the boring stuff like the Microsofts of the world. If we look at the challenges we're facing with supply chain, and you're going to have maybe a better logistics software to deal with multiple suppliers. If you have a hiring problem, well, then maybe you look to automate in certain ways. So I think those types of companies, again, longer term, in the short run, they might have a difficult period, but longer term.
Absolutely. If you believe, what Warren Buffett looks at when he, when he buys a company, and his largest holding at Berkshire Hathaway is Apple, by the way. But, it is, barriers to entry, moats around the business and so forth. I mean, the barriers to entry of competing against utility technology is, obviously anything can happen, and there's obviously some competitive threat out there, but it's hard to see. I mean, and if there is a competitive threat, these companies, their balance sheets are so strong, they just go and buy out the competitor. They'll just take it out. And there's other technology companies, or I guess you can call them like fintech type companies, like the MasterCards and the Visas. This environment's actually very good for them in an inflationary environment because 100%. Prices are higher, and they're taking a clip on.
They take a percentage, So if more money spent, they make more money.
Now, there's obviously risks to the coming year. What do you guys think might be based on what you read? What is
there's always a risk.
There's obvious ones, right?
Well, you just never know what the central bank will do, right? As much as we all think that this is how it will unfold, there can be surprises. Think about geopolitical events.
I was just going to say
that's a big one, right? That's more so than we've seen in the past. Like in the past, it was all about globalization, working together, open borders. We're in a very different environment now. Like for the first time in a long time, you have to look at the companies and say, where do they do their manufacturing? What happens if a country like China says, you know what? No more. We're not going to play nice, and we're going to shut things down. What are you going to do then? So you do have to be mindful of that. I think when you're looking at your companies more so today than you had to in the past.
And I agree. I think personally, I was going to answer to answer Sean's question in terms of risks. I was going to say, I think geopolitical tensions and geopolitical factors are going to be the biggest risks. And the most volatile in the next couple of years. Who knows?
So I read something scary on the weekend, and I can source it. No, I mean,
don't tell me another Cold
War.
War.
Nightmares.
Well, it actually. So there's a think tank in the United States. It was kind of reported on CNN, and then backed up by some other various reports. But this is a real time. I could get the name and I can post it on our podcast notes. But they did the largest war simulation or war game simulation on a attack from China to Taiwan, defended by the United States and Japan. And Taiwan, the Taiwanese army. And they basically ran 24 to 25 scenarios back to back to back to back. And the net outcome was that basically the U.S. would win, but their Navy would be just destroyed. set back about 15 to 20 years.
Mhm.
The Chinese Navy, the same,
Mhm.
destroyed, set back 15 to 20 years. The Japanese Navy would be wiped out. So I mean, and go on and on and on. The Taiwanese Army.
I want to read that or
It was something
or watch
else.
it.
And so, I mean, the good news they said is like because of the they like obviously the U.S. military is doing these modelings, and so is the Chinese military and so forth. The good news is that they're seeing the same data. They're like, okay, if we really want to push,
You
this
want to
so
avoid
far,
that,
It's gonna be
yeah.
we're going to be just
Yeah.
no. There's no winner out
Right.
of this, really.
Right.
But I mean, 15 years ago, 20 years ago, who was talking about that kind of scenario, right?
Yeah.
I mean, to me, I actually think in the Ukraine, the geopolitical risk has gone down a little bit, and here's why. I think early on in the conflict, there was always this underpinning of a threat that Putin could use some sort of
Nukes.
nuclear option.
Right. Right.
But as this war drags on, he hasn't done it yet.
Yeah.
And the rhetoric of using a nuclear option has somewhat dropped off a little
Yeah,
bit.
that's
So I think-
true.
So I think that geopolitically very unsettling option is not as let's say probabilistic today as it might have felt, let's say, 3
Early,
to 4
yeah.
months ago.
Yeah.
Yeah.
So I think that's a positive. So for me, I think the greater impact is because we don't know the impact of interest rate increases, until let's say 9 to 12 months after the fact. And we literally wrote, rates increased in December. We won't really know the ultimate impact on the economy until this time next year.
Okay. So
Okay, so that's
half
the real risk is we don't know if we put on the brakes far too hard, or maybe to your point, Jalal, maybe we didn't put it on enough. Because I think most price inflation is probably going to abate in the coming year. But what I don't think central banks were counting on is the stickiness of the wage price spiral.
Right. Yeah. Yeah.
We
That's
gotta
a
see
tricky
that
one.
starting to come
Yeah.
up. So
Yeah.
that's to me the greater
Yeah.
risk for us sitting here in Toronto,
Yeah.
Ontario, at King and
I mean, they're both.
King, New York.
In my opinion, they're both risks. Like whether it's inflation or wage growth or whatnot. By geopolitical, I think I just meant that not only war, but just the animosity that's growing between countries. Like, because I read, and the reason I'm saying this is because I read a lot about what's happening with TSMC, for instance, and what's going on in the. I'm not really like the smartest guy when it comes to health, but when it comes to tech, I like to keep up my stuff there, and just the tech world in terms of the manufacturing and the supplyment of it is changing a lot, right? And that's why I see like. Companies, as you said, Amy, closing borders between between each other, and so who knows how companies are going to react to that? I guess now,
And you're starting to see trading blocks similar to Cold War trading blocks cropping up. Right?
Yeah.
Like you saw,
Yeah.
I think Russia is increasingly leaning on North Korea and China for weapons supplies and so forth,
and Iran,
and Iran as well. So
Yeah.
and you can see obviously NATO's NATO, and they've just literally said, okay, now's the time for Sweden to join. And so on. So you're right.
And then you also have like what the Yuan Petro. Like I was reading yesterday that China's going to start probably implementing, or they already have started implementing, buying oil in the base currency as the yuan rather than the US dollar, right? So all that's going to be that's going to have huge impact globally. And as we all know, anything that happens to oil, it ripples through the entire economy.
Right.
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 So, but
I think when we look back, and every year we're always surprised at what could happen. And I always tell people we just prepare for the next crisis. There's always something, right? Like 100%. Who would have predicted a pandemic?
Yeah.
We were reading a book recently. We'll talk about it on our other podcast, but The Psychology of Money. And I like the way he phrased it was you have to be a paranoid optimist to be an investor. And I really like that because it's like you have to be paranoid to be worried about these things to build in enough buffer and make sure that you've planned accordingly for your clients. But also you don't want to be too doomsdayer because generally as a human race, we figure things out and we move forward. So there's that paranoid optimism.
You don't want to be naive.
But this is why you want to resist the urge to abandon being a balanced investor.
Exactly.
What happened last year. And I'm going to quote, JP Morgan in their 2003 outlook. They said, the potential for bonds to meaningfully support a portfolio in the most extreme negative scenarios. We went through a couple of them. We're not trying to be Pollyanna here.
Yeah.
Such as a much deeper recession than we envision, or in the event of a geopolitical tension, we cover that, is perhaps the most important for multi-asset investors. For example, I covered this. If a 10-year U.S. Treasury bond yield falls from 4% to 2% between November 2022 and the end of 2023, that's a 20% return
Right.
on that bond.
Right.
And then they finished to say, after the pain of 2022, the ability for investors to build a diversified portfolio is now the strongest in over a decade. Okay. They were saying both stocks and bonds look attractive now.
Yeah.
But fixed income, again, deserves its place in the multi-asset toolkit.
Yep.
So that's I think this year, having bonds in your portfolio could defend against some of the risks that we just talked about.
Exactly. Well, here's to 2023.
All right, guys.
Well, let's see what happens, everybody.
All
Let's
right.
do it.
Okay. Have a great day, everybody, and we look forward to talking with you soon. Feel free to give us a nice little positive rating if you're asked to by Spotify or iHeartRadio or whatever. We really
Or send
appreciate it.
or send us some feedback on ideas
send
for
us
the year,
feedback and we'd
year
be happy
ahead.
to
Even if it's a
accommodate.
background, if anyone has ideas about
Yeah.
backgrounds, let us know. I hope you guys all like it. Bye, guys.
Bye. It's me again with the disclaimer hat. So as a reminder, everything we covered today, that the sectors or securities mentioned in the podcast are not suitable for all types of investors and should not be considered as recommendations. Please consult your wealth advisor to verify whether the sector or security is suitable for you and to obtain complete information, including the main risk factors. Some of the securities or sectors mentioned may not be followed by analysts at National Bank Financial. Thanks, guys. Talk to you soon.